Way Out West says, when you evaluate or present policy illustrations, do I request or present the low, mid, and current dividends, or just the current? I usually just do the current. Now, I do make sure when I'm talking to people that they understand that the illustrations in general are just a projection of what could possibly be. We don't know what's going to happen going forward. The illustrations have a guaranteed column and they have a current column. They have an alternative column too, which shows all three. So the all three get represented. The alternative, though, is just like the exact middle in between the current and the guaranteed columns. It doesn't really mean anything. The guaranteed column doesn't really mean much of anything because we're going to automatically do better than the guaranteed column. If we have a whole life policy, the guaranteed column assumes no dividends ever and maximum insurance charges. Well, the carriers that we're using have been paying dividends for 150 plus years, every year. So odds are, and we already know they're going to pay a dividend the first year. Odds are they're going to pay a dividend the second year, in which case that guaranteed column is blown out of the water. And the odds are they're going to pay dividends every year we own the policy. I mean, that's why we get into those ones. On an IUL, the guaranteed column assumes zero return in the index every single year and maximum insurance charges. We know that's not going to happen. An index, the beauty of the IUL, when an index drops, you get an annual reset. So it's not like you're in the stock market, where if the stock market loses 50%, you have to get 100% to get back to even, and then you start making money. With an index universal life, as soon as it starts to go back up, you get to go back up because you get that annual reset. And we don't usually see the stock market go negative year after year after year after year. It's usually a big drop, and then it takes a while to get back up to even. But in an IUL, you're going to get those gains each time. So I don't put much stock in the guaranteed columns of those. I don't worry too much about those being the reality. The actual current column probably going to be closer to reality because we're in a low interest rate environment. Dividend rates have been coming down. I think down the road, dividend rates are probably going to be coming back up, or they're going to be kind of hanging out around where they're at right now. They might still come down a little bit, but there's not a whole lot further lower that they can go. So I don't really worry too much about variations in that. If we design the policy right, the costs are minimized. Even if we just get some growth in those things, they're going to be pretty good. They're going to be pretty good performers. So I don't worry too much about those other ones. But I do like people to understand the limitations of the illustrations that we're showing. Because the limitations are, we've got to put something in here so that you can, one, see what's possible, what might possibly happen in this thing. And we go based off of history and what's currently happening. And then two, you've got to be able to compare it to other companies somehow. And so the good way to compare it is, what is everybody currently paying for dividends? What are the index options they're currently doing? What are the historical returns for those index options currently? So there's value in it, even though we can't really, we know they're not actually going to happen that way because they just can't. They assume the same rate every single year moving forward. That's just one of the limitations. So as long as we take those under advisement, we realize that we have the ability to manage these policies, manage the costs in these policies if necessary. There's ways to get out of these policies if necessary. If somebody comes out with just an amazing product and you're like, oh, I wish I had that one instead. Good news. We have 1035 exchanges. We can move into those ones. If they're that great and it's worth it, we can do that. So there are ways to mitigate any of the risks inside of the policies that might present themselves. So knowing all of that, it makes it a lot easier. It makes it a lot easier to take the illustrations and understand them for what they are, which is what we can use to compare them to other companies. Let's see. Good question, though. Good question.
I hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time.
Now go maximize your cash flow.